Welcome back to another episode of the Stoic Trading Psychology Podcast. Thank you for everybody for continuing to listen to this podcast. I am FX Telepath over on YouTube. If you are finding me just scrolling through podcasts, I've been trading and forecasting the markets for pretty much over 6 years now. So if you guys haven't watched my YouTube channel, go check it out at FX Telepath if you want to follow along with my weekly forecasts where I actually predict price movements before they take place on video. No screenshot P&Ls and all that fakeable stuff. So we try to keep it realistic here and keep it very transparent as much as possible. So hope everybody's doing well, and let's get right into the episode here where we'll be discussing why I think supply and demand trading is superior to other strategies. Now, before we get into it, let me be very, very clear. I am not saying that supply and demand trading is the only strategy you should trade. I'm not saying that supply and demand trading is the holy grail. I'm definitely not saying that as well. There is no holy grail. The holy grail is whatever strategy that works for you. And I'm also not saying that somebody who says I'm profitable with support and resistance or chart patterns or SMC or whatever other strategy they're trading, if they are profitable doing that, I believe them. I'm not saying that supply and demand is the only profitable strategy. So I have to get that out there first. And I've brought that up before. I've been completely honest. I do trade supply and demand. I've been trading supply and demand pretty much my entire trading career. I did start off trading support and resistance, and I was kind of looking at flag patterns and stuff like that a little bit. But that was very, very early in my trading. That was right at the start of my trading career. It was like support and resistance based. And then it became like where you're drawing a line on a chart. Then it was pretty much support and resistance zones. And then from there, I just kind of started to get into supply and demand zones. And again, so I started off with that. But as soon as I heard about supply and demand trading, it really clicked with me. And for those of you who do trade supply and demand, I mean, I've gotten so many messages over the years from people saying, yeah, I trade support and resistance, I trade this strategy, but supply and demand is really the only one that makes logical sense to me. And that I definitely stand by. That's a statement I stand by. Even if it's not supply and demand, it is because it is price action. Price action is king. So I guess the title of this podcast really could just be why price action trading is king, or, superior to other types of strategies where you are not using price action. You are using lagging indicators and fundamentals and all that kind of stuff. Price action is king. And the reason that price action is king is because you're seeing what's actually taking place in the chart. If price went up from a certain area, like let's say the stock, let's just use stocks for the example. Let's say a stock is at $100 for, I don't know, it's ranging between $100 and $102 for like a day. And then price shoots up aggressively from that area. Obviously, there was tons of buyers in that $100 to $102 range. That price shot up drastically. Buyers exceeded sellers in that area. That's kind of the concept of supply and demand, which we're probably going to get into in this podcast. But it's the idea that you can see that on a chart. It's price action. You can see where a support area is on a chart because it's been created. You can see that it's a support area. Clearly, when price comes down to this general range, it's bouncing from that area, and that is price action. And that is superior to trading chart pattern, or I guess chart patterns is price action, but I mean indicators. That's what I'm thinking of. Sorry. Indicators, clearly they're lagging. So you're not really basing anything off of price. It's like based off of some indicator where it's like, oh, when it gets below this point in this coded thing, that means it's time to buy. And that doesn't really make much sense if you think about it, because everybody could just put on an indicator on their chart and become profitable, I guess. And that's just not the reality. So again, it's more about price action rather than just supply and demand trading. But obviously, I do personally think supply and demand trading is better than every strategy. That's why I traded. Obviously, I wouldn't be trading supply and demand if I thought that trading flag patterns was better. I'd be trading flag patterns or both, but I don't. So obviously, I can't deny my bias. But again, like I mentioned earlier, the reason that supply and demand trading is king is because when price is at a certain area, it's basing out, right? So on a 5-minute chart, that basing out might take, so remember I was telling you guys $100 to $102. Price could be ranging in there for a day, and the price breaks out of that range obviously that's where the demand zone would be, around that $100 to $102 mark, because that's where price was last basing before we shot up aggressively. That could, on a daily chart, that's going to look like a couple days. But a supply and demand zone on a 5-minute chart, that basing is going to only take a couple, maybe like an hour, right? Price could be basing out on a 5-minute chart for an hour, and then all of a sudden we shoot up. That would be our 5-minute demand zone. So the reason that supply and demand trading is king as well is because it is where it's basically, we're mapping out where the institutions are trading from, most likely. And the logic behind that is, like we said, you guys definitely got to go watch my full course on YouTube. It's like an hour and 40 minutes. It's got the most views on all of my videos. It's definitely the best video I've ever made. I got so many positive comments on that video. It's been absolutely crazy. You definitely need to watch that video because I break this down with visuals, and it's much easier to understand. So I definitely recommend going to watch that video. But we're basically spotting where institutions, large players, banks are accumulating and where they're distributing essentially for supply. So you can pretty much see their footprints on a chart, because when you see such an aggressive push up, right? Everybody hopefully by now can understand the difference between a basing candle and a massive rally candle. Now it does become a little bit tricky, where is that really a rally candle? It does get tricky sometimes and definitely nuanced, but in general, everybody can really tell the difference between an explosive candle and a basing candle. So when we have both of those combined, that is what a supply or demand zone is. For a demand zone, we obviously have basing candles followed by an aggressive, explosive candle to the upside. For supply, it's the opposite. We have basing candles and explosive candle, red candle to the downside, or whatever colors you guys are using. Everybody's using crazy colors on their charts these days. I mean, some of them are cool, but I like my green and red. But anyways, that is what a supply and demand zone is. So obviously, when you're trading like the Euro USD or the futures markets or a popular stock, only large players can make those moves, because what that means is, again, let's say price is ranging from $100 to $102, meaning, let's just say it's a daily chart. So we'll use that same example. Price is ranging from 100 to 102. So every time price gets to 102, we sell off. Every time price gets to 100, we start to, buyers start to pick it up again. Obviously within a range. I'm not saying exactly on the T. It's going to be like $102.30 and $100 or $99.55, like in the general range. And then if price shoots up after that, so maybe the fourth time we get to the $102, it shoots up very aggressively. Now we're at, and after one daily candle goes from 102 to like, I don't know, 110, let's just say, for example. That's an explosive move away. Obviously, we still have to look at it on a chart. We're not just basing it off of numbers. We're always looking at, the chart and the candles. But the concept of that is, I can't buy, I don't discuss how much money I have, whatever, but trust me, I don't have enough money to move, the Euro US dollar or Apple stock or the futures market. I don't have enough money for that. Your local richest guy in your town or city, wherever you're from, he probably doesn't even have the money to move that unless he piled all of his money in, which he's not. So that's kind of the point. When we see those large moves, we have to say, aha, that is the large player, the institution, the bank, whatever. I'm not going to speculate on who it is. All I know is that's a lot of capital in that area. And then if you just follow along, so for number one, you identify, that's a lot of capital trading in there because we saw an explosive move away. That is our demand zone. Well, then the next thing we have to think about is, well, we couldn't predict that. Nobody can predict when that move is going to take place, that explosive move. So we have to let that happen. So then our next thought we have to think of is, well, should we buy on the return to that zone if we do get a return to that general area? Probably. Why wouldn't we? If that's where the large players were accumulating or distributing before, why wouldn't we trade with them again? And I guess you could kind of compare it to, if let's say you're an up and coming, I don't know, just for example, a toy company, and you're using this one, and you see that the biggest toy company, they're using that factory. Why wouldn't you want to use that factory as well? Because obviously the big toy factory that you're trying to, compete with, they're using that factory where they're building their toys. Why wouldn't you want to use that factory as well? Obviously, they know what they're doing. So it's the same concept where if the large players and the institutions were buying at that price point, why not buy there again? And there is some logic also where they might have some leftover buy orders there. So they might, let's say they had 100,000 orders to fill at from $100 to $102, like we've been saying. 100,000 orders. Well, over the day or whatever, I'm not going to get into specific time frames and times and stuff like that, but like, let's just say over time, they only got 75,000 orders filled, which still shot price up, creating that demand zone. But only 75,000 were filled. They still have, for everybody, you've ever placed a trade or bought in shares, all your orders are filled pretty much instantly because you don't have enough money to where it's like kind of a pain, where you have to like wait for a fill. So when you're trading with a large capital, if you put up an order at $102, you might actually move the market, and you have to literally get price to go back down to fill in the rest. So that's another concept of supply and demand, is we are buying where those leftover unfilled orders are. Now, I think personally, my hunch and my thoughts that I've been thinking over the 6 years of my trading is, I think that does take place. I think that does happen maybe a little bit more on the day trading timeframes where they're trying to fill on a certain day. And then I think it does. I think it happens on really all time frames. But then I guess what I'm trying to say is when the zone is really old, like, so let's say a zone was created. So for example, we have a zone on oil right now, at whatever the time. This is, I'm recording this on February 14th, 2026, Valentine's Day. And there's a weekly demand zone below some liquidity. I've been talking about it in my weekly Forex forecasts on YouTube, which I release every Saturday, by the way, so you guys should definitely check those out and follow along with me if you haven't. And basically so there's a weekly demand zone on oil, and I've been waiting for that zone to be hit, but it was created, I think it was like 2022 or something like that. I forget the exact year, but it was like 4 years ago minimum. And that's an old zone, but I like it because there's liquidity before it. I'm not going to get into too much detail, but it's a weekly demand zone. So it's like, it's old, but it's not like I'm trading, a 1 hour zone from 4 years ago. It's a weekly zone from 4 years ago. It's a little bit different. So it's not like super old in that context if you think about it on a weekly chart. But what I'm trying to say is that is an old zone. So do they really have leftover buy orders there? Probably not. I just think that maybe, since again there's liquidity before the zone, there's going to be stop losses there, and the fact that maybe they've bought at that price point before, and that might just be, a price they would like to buy at again. I think that it is possible. That's why older zones work. I'm not really saying that they have a leftover order from 4 years ago still in the market. I don't think that that's reality. But I think that if it's like a couple days or a couple weeks or even maybe a month or two, I think that sometimes there are some leftover buy orders, and that's why we do see nice moves off of our zones sometimes. So that is a huge reason why I think supply and demand is objectively superior to other strategies in that way. But again, I'm not saying it's the only strategy that you can trade or it's the only profitable strategy, but I doubt that anybody could ever, and I'm not saying that this is not possible. I'm open to, I'm all ears if somebody can explain to me logically why other strategies would make sense in that aspect, because basically what we've identified is that the large players and the institutions and the banks, those are the ones who are winning, right? In the long run, those are the ones who are winning. So we want to trade with them. So they're the ones who are winning. We want to trade with them. And then we are able to objectively identify where they were buying, because we can't move the markets like that. Only they can. So it is like literally an objective thought. There's no subjectivity to that at all. And there is some subjectivity to like, oh, well, it is a question of, are they really buying there again? Is there really leftover buy orders? I guess I don't have evidence for that, but I mean, my evidence is in watch my forecasts. I mean, and all the members can attest to that as well. We see many reactions off of the zones. It's not 100%. No trading strategy is 100%. You can actually have many strategies where you're losing, where most of your zones fail, but you still win because you are getting massive trades, because you understand the higher time frame context. So that is why it's an objective reality, supply and demand. And it does sound like if you don't know anything about trading, I'm sure somebody will be like, oh yeah, for sure, man, it's objective, right? But it truly is, because we don't make those moves in the markets at all. So, and the thing about supply and demand is not just trading the zones. For anybody who's in my group or who has just been following along with my forecast, they know that I take trend lines very seriously as well. Trend lines are a massive part of my strategy. Trend is a massive part of my strategy as well. It's not just mapping out zones and just placing an order at the zones. It's not. There is more to it. And one of the biggest parts of supply and demand trading is understanding higher time frames. And I know other strategies obviously use higher time frames as well, but we really put an emphasis on higher time frames. And what that allows us to do is, if you have identified that let's say you're trading a 5-minute time frame, you are a day trader, your higher time frame would be the H1. So that's just what we use with supply and demand, it'd be the H1. Well, if you understand, so if you're just trading the 5-minute chart, you might see that price is blatantly trending up. We have a blatant trend line. Everybody agrees that that's a 5-minute uptrend. And you might be saying, oh, I got to get in long and I'm going to ride this trend all day and get a massive 5-to-1 trade. And that's what a lot of people are doing. They're using one time frame. And that might look like a great trend to the upside. But the reality is, if you go to an H1 or even a daily chart, you might see all trend lines to the downside, and then all we're getting is a pullback up to that trend line, and then we're most likely going to fall. So that's why using multiple time frames is so relevant to supply and demand. It's supply and demand zones combined with a strong understanding of higher time frames. And then it gets complicated where, let's say you want to look for longs on a 5-minute chart because you see that nice 5-minute uptrend, you want to ride that trend. But again, the H1 is trending down and you're not understanding that. Well, where it gets a little complicated is, well, where are we at in the daily, right? So that's 3 time frames we're using there, where, okay, well, the H1 is trending down, that's great. But if we're at a daily demand zone, then the 5-minute longs actually are not a bad idea. We can get a pretty good move off of it. So that's where things become a little bit complicated, and I'd pretty much stick to 3 time frames max. You don't really need any more. I can use more, but it gets complicated and kind of unnecessary. If you're looking for a 3-to-1 trade on a 5-minute chart, you don't really need to go to a weekly or a monthly. It's not making a whole lot of sense. If you're looking for 10-to-1 trades, then maybe you do. But so what I'm trying to say is that it gets complicated with multiple time frame analysis, but having a strong understanding of multiple time frame analysis is so vital to supply and demand trading. Mapping out supply and demand zones is tough. You have to understand what to look for. You have to keep it somewhat rule-based. All my members know that my strategy is very, very rule-based for identifying supply and demand zones within my chain analysis, because we go over it on Sunday and we have like an hour and a half, sometimes a little bit longer than an hour, Zoom session where we do homework and map out zones, and they understand my chain analysis and the reasons I draw the zones. And it's very, very rule-based. Sometimes it does get a little tricky where you have to kind of avoid your rules a bit, but it's like 98 to 99% of the time, I have a very rule-based, very specific way of identifying zones, and that just helps keep things very consistent. But again, that's one thing, finding the zones, but understanding how to draw a proper trend line, understanding what a trend is, understanding the higher time frame bias, where you are considering trend and the curve, and where we are at in the curve, which is basically just higher time frame zones, is key to the strategy. And that's another thing. People say, well, what are the higher time frames saying? And it's like, that's not even a good question. And I'm not giving anybody a hard time for asking that question, but the reason that's not a valid question is because, well, what time frame? There's no such thing as a higher time frame, really. For me, I consider my higher time frame the daily and the weekly, and anything above that. But a 1-hour chart could be your higher time frame. In reality, if you're trading the 5-minute chart, the 1 hour is your higher time frame. So there's no objective higher time frame. So when people say, well, what's the higher time frame saying? It's like, well, what's your entry time frame? And then I'll tell you. That's kind of the concept of that. And another reason that, supply and demand is so superior is because these zones, part of the gurus have changed the way this strategy is, but we trade at fresh zones. We don't trade at tested zones, Tested zones are usually just support and resistance areas. So I don't trade at those because, again, going back to the logic of the strategy, why it's so logical is we want to be trading with the banks and the large players. We don't want to be trading with retail traders. And what's a very popular retail trading strategy? Support and resistance. Again, you can be profitable trading support and resistance. I've met, not personally, but I've seen people trade profitably with support and resistance. And I'm not saying it's not possible to do that. I'm just saying when you are trading at support and resistance, it's usually with retail traders because everybody can identify a blatant high and low. And a lot of the times we will see liquidity sweeps or whatever you want to call them at those areas. And a great thing about supply and demand is so rule-based. And that's the thing about my forecast as well, where it's like, I've seen other forecasts on YouTube and they're not bad. Like, they're definitely putting themselves out there, and that I respect a lot. But it doesn't seem like they have a risk-defined, like they obviously are, I believe that they're profitable and stuff. I'm not calling anybody out at all. But when I'm pointing out, like, this is a zone, when you see a zone from this, it's a zone on the chart, right? It's a section of price. That's the zone. You can see my zones when I'm forecasting. You guys know where my stop's going to be. It's going to be under the zone. Lately, we've been having wider stops, and that's been very successful with Mr. Trump in office. It's just wider stops are better to have in these market conditions. But you know where the stop's going to be. It's going to be under the zone, where people just be like, oh, price is going to go up to there. And it's like, okay, but where's like your entry at? You know what I mean? So there is, forecasting is one thing, but forecasting where it's like I'm putting myself out there where you can see the zones that we are, potentially trading at. You know where the stops are, so you can tell if that's going to be a loss or a winning trade. Where a lot of the other ones are just, there's no risk. So that's what I'm trying to say, is the risk management is built into the zone. That's what makes it's such a simple strategy as well, where it's like, that is where your entry is. There's no breakout orders or any of that. We don't trade breakout orders. It's always, that's our zone. Your entry is going to be pretty much right at the zone, a little bit above, and your stop's going to be below, maybe even further below if the market conditions require that. So again, that's why supply and demand is superior, because we have that risk management built into the zone pretty much. But again, none of this really matters if you don't have your proper trading psychology down, which is why I do this podcast, because we try to keep it stoic. We try to keep it about trading psychology. I wanted to kind of maybe move on to other things as well, like talking about certain strategies. I definitely have some other podcast ideas where it's not really trading psychology based, but just kind of moving into different topics and stuff. So hopefully you guys appreciate this as well. I still, this whole I'm trying to build a bigger podcast here and a bigger audience. So those other, I don't really know what else to say about the strategy. I think it's a great strategy, and if anybody's ever traded it, they understand the logic behind it, hopefully. And again, I have that full course on YouTube where I break it down with, it makes more sense when I'm talking about the explosive candle and all that stuff. It makes more sense when you are seeing it. So, yeah. Anyways, guys, we're going to end it here. Hopefully that makes sense. And please don't make it out to me saying, oh, that's the only strategy you should be trading. If you have something that works for you, that's great. And I think that's awesome. And that's really the holy grail strategy. I've talked about it before. The holy grail is whatever works for you. If you have some strategy where you only buy on a full moon, and when your favorite baseball team loses, and then that's your strategy, okay, trade it. If you're making money, go ahead, go right ahead. Don't come to supply and demand trading if that's what you're doing and it's working. Literally don't. So anyways, guys, hope you enjoyed this podcast. Remember, we have to be stoic as well. We cannot just take trades blindly, and that's why signals don't work, because if you don't have the mindset down to hold the trade longer, you can't do it, and you're not going to make the returns that others are making if you don't have your psychology down. So like one of the last podcasts I did, become a better person, become a better trader, work on everything overall. Try to get a good full-time job. If you don't have a good full-time job, get a better job. If it's not paying enough, do what you can. Build the real-life skills to get a better paying job so you can fund your account. Because you're not going to turn $50 into $50,000. You're just not. Anybody who's ever taken it, anybody who's ever traded for a month knows that nobody's turning $50 into 50 grand. Anybody who's traded for 2 weeks knows that, because they start trading and they get run over and they're down 5%. It's like, okay, these guys are really making 100 grand in a day trading. They're claiming, yeah, right. So it's just funny. Anyways, a little bit of a rant there, but hopefully you guys enjoy those. Seems like you guys do. So take care, guys. Hope you enjoy this podcast. Let me know what you think. Cheers.